Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over some of the top safe haven, recession proof, safest investments that you can invest in the stock market while we're in the 2020 recession. So, before we get into that, a quick portfolio update. My stocks have been doing pretty good as of late. As of today, right now, the market is still open. We are currently up 1.29% with $20.50 in gains. And since we have started the portfolio, we are now up $110.55, and we're up about 7.37%. Some of the top gainers in the portfolio, leading the portfolio is Discover Financial Services, Foot Locker, and Whirlpool. And we now have 1, 2, 3, 4, 5, 6, 7 different stocks that are all up double digits, and including some of our top holdings such as Visa and Realty Income. On the worst performers, that means that every single stock that we have in this portfolio is now up because the smallest gain is Procter & Gamble. We're up a nickel with 0.11% in gains. And so everything's going good so far, as you can see here. Now, remember that we're not really too focused on market gain. We're more focused on earned dividends rather than market gain. So this number is not as important as this number. We want this number to go up, of course, that's wonderful, but we want earned dividends to go through. In a couple of weeks, we should be getting our first dividend. I believe Foot Locker will be the first dividend that we'll be getting in about 2 weeks or so from now. But yeah, everything's going good in the portfolio. We've had a couple green days in the market, and hopefully it stays that way. And if it goes down, then I'll definitely be doing some more deposits. Regardless, I should be making another deposit to the portfolio pretty soon. Hopefully waiting for a big down day in the red. And everything's going good. So let's just jump right into it. So the first stock on the list is Cardinal Health. Of the stocks that I'm going to be recommending, I have 8 different stocks. 7 of them are dividend stocks. 1 of them is not. And of these stocks that I'm recommending, these are not just stocks that I own in my portfolio. Some of them are, and then some of them are not. Some of them are stocks that I thought about adding. They didn't make the cut for a couple different reasons, and I'm going to be going through that. But Cardinal Health is a perfect example of a very safe investment that also pays very good dividends. This is what I talk about when I talk about need-based necessity products. This is something that will not lose demand based off of a recession. In this situation, it might actually even increase demand. So what has caused this recession is obviously because of an illness, and people get sick, they're forced to go to the hospital. If you get in a car crash, if you have some kind of deadly disease, if you get the new illness that is going around, whatever the case may be, you're going to need medication, you're going to need treatment, you might need surgery, you might need whatever. Cardinal Health is a perfect example of a stock that is a need-based stock that is not going to have any demand soften just because of the recession. So this is a $14 billion company. They have a dividend yield of about 4%, 3.9, so that updates daily. After today's small drop, I'm sure it's right around 4%. And if we go to the financials, this is something that's really important for any stock. In a time like now where we're in a recession, cash is such an important necessity for a company. Obviously, you don't want a company that has a ton of debt or slowing revenues or anything of the sort, but having cash on hand to pay dividends, to come up with any shortcomings that might be happening in slowed sales in the next 6 months, year, whatever, having cash on hand is so important. So when you see a company like Cardinal Health that has $2.5 billion in cash on hand, that is a very good stockpile, especially for only a $14 billion company. That's pretty substantial. So when we look here, they have $2.5 billion in cash, and their long-term debt is $7.5 billion. So that's about a 3-to-1 ratio. That's not that bad. That's very sustainable, and that's not anything that would take this company down. They are a dividend aristocrat. Cardinal Health has raised their dividend consecutively for over 30 years, which is very impressive. The Dividend Aristocrat group is a very hard group to get involved in, and those who come and join it usually do not stay. This is one of the stocks that I believe will stay, even raising dividends in the 2008-2009 recession. I don't think this is going to go away anytime soon. You see here all the way back in 2009, they were paying 17.5 cents per share every quarter, and you see it keeps on going up here, and now they're all the way up to 48.1 cents a share every quarter. So I don't think that's going to stop anytime soon. And as you saw that 5-year chart, they're on a very large downtrend, and I think now is becoming a very a very optimal time to buy the stock after it's on a huge discount. As you can see here, in 2015, it was about $88 a share. Now it's about half that. It's about $48 a share today. So a very significant decline for a very safe business model that's not going to go away anytime soon. This is one of the largest healthcare companies in the world, and I would consider adding this to my portfolio if you're looking for safe haven recession-proof stocks. So the next stock on the list is Aflac. I do not own Aflac in my portfolio. It was one that I actually considered adding. There was a couple reasons why I didn't. Aflac is an insurance company. I'm sure you all know about it. It has a $25 billion market cap, and it has a dividend yield of about 3.18%. Aflac is also on the Dividend Aristocrats group, or raising their dividend at least 25 years consecutively. And if you look here, if you go to their financials, they have about $5 billion in cash on hand, so about double that of Cardinal Health's. As an insurance company, they do have to keep a lot of cash on hand, which I think is very handy in a time of a recession. And if you look at their long-term debt, so they had $5 billion in cash on hand and $8 billion in long-term debt. So less than twice of what their cash on hand is. So they could pay off the mass majority of that long-term debt overnight if they needed to. So for Aflac, they primarily focus on health insurance, short-term disability, things like that. So what they do is they calculate how much they're going to pay on average every single year, and they figure out how much to charge on premiums, and they always work in a way to where they're always going to charge more on premiums than they will on paying out to claims to customers. So what they do when they get those premium money, they take the money and they invest it in short-term investments. So Aflac trades a lot like a bank. So a stock that is hit hard in a recession is the banking sector. Insurance companies go along with that as well because they make the money off the interest collected off those long-term premiums. What they do is they invest those in governmental bonds, usually long-term treasury notes, stuff like that, and they collect interest off of them. When interest rates are lowered, like they are now, 1.5%, that means less potential gains off of interest for Aflac. As you can see here, they raise their dividend every single year. They just raised it this quarter. They raised it from 27 cents up to 28 cents, down from 26 cents. There was a stock split. And you can see it keeps on getting raised every single year. And this is a very safe and stable company, and they primarily focus in the U.S. and Japan. Japan is actually one of their larger markets. It's one of the only other countries that they operate in outside of the U.S. One cool thing that a lot of people don't know about Aflac is that their employees are commission-based. So they're foot soldiers that are out there every day selling to potential clients, trying to sell insurance premium. When they sell insurance premium, they get a commission. So let's say they solicit to a business and they get $1,000 sold in premium. They might get to say keep 60% of that, hypothetically speaking. What Aflac will do will pay 60% of $1,000. They'll give them $600. Okay. Then the next year, when it comes time to renew the premium, if they go to that same business and renew the premium, they will get a smaller percentage. Let's say 20%. So if I sell $1,000 worth of premium today, I get $600, and then next year I renew that premium, $1,000, I get to keep $200 of it. What Aflac does, instead of paying their employees $200, what they will do is give them $100 in cash, and then we'll give them $100 worth of Aflac stock. They will spend that $100 to invest back in the company in the stock. This will boost retirement as dividends are paid out, as all the other employees are contributing. They don't have a choice in this. And this will help them save for retirement, but it also benefits the company because it raises the stock price, and that's more dividends for the employees to get back. And if you're not an employee there, like I'm not, and I'm sure 99% of you aren't either, it helps the stock out because employees are constantly contributing to it, not to mention 401k matching. I'm not even mentioning that. But that's just one cool thing that Aflac does that I think is pretty interesting. And yeah, this is a really safe and investable business model that is here for the long term, and this dividend is very safe, and so is the stock in general. The next stock in the portfolio is one that you saw in my portfolio and is also the thumbnail for this video, which is Pepsi. It's one of the largest investments in my portfolio, the top 10. It has 4%, and I'm currently up 5.58%, or about $3 on PepsiCo. So one of the things about PepsiCo that I really like is how it is so diversified. There are so many different products out there that PepsiCo has that I'm sure you didn't even know of. They have a multitude of brands, and recently they actually just purchased another brand, Monster. This is going to be one of the only brands that you don't see on here because Monster was just recently purchased. They haven't updated the website yet. So I'm on Pepsi's investor relations page, and they have so many different brands. So I'm just going to name these off real quick. Some of these I'm sure you've heard of. A lot of them I have heard of, and I'm sure a lot of them you even drink and eat every single day. So they have Pepsi, Pure Leaf, Mountain Dew, Bubbly, Gatorade, Tropicana, Naked, SodaStream, Lipton. Oh, by the way, so Starbucks, they obviously don't own Starbucks, but what they do is they package these little cold frappuccinos that they have bottled. You'll usually see at gas stations like On Q's and 7-Elevens. What they'll do is they'll bottle those and ship those out for Starbucks, and then they'll obviously get some of the revenue from that. Aquafina, Brisk, Kavita, Lifewater, Sierra Mist, Stubborn, Izzy, Propel, One, Sophie, and Mug Root Beer. That's all their drink brands, and then Monster, like I mentioned. On the food side, they have Lay's, Doritos, Stacy's Pita Chips, Quaker Oats, Bear, Sabra, Ruffles, Smart Food, Cheetos, Tostitos, Fritos, Near East, Maker, Imagine, Sun Chips, Smart Food, Off the Eaten Path, Simply Lay's, Rolled Gold, Miss Vicky's, Himalayan Pink Salt, Cracker Jack, Nut Harvest, Life, Matador Jerky, Chewy, Santitas, Funyuns, Cap'n Crunch, Pasta Roni, Rice Roni, another brand of Quaker Oats, Maui Style, Sabritones, Munchies, Munchos, Grandma's Cookies, and Aunt Jemima. So that is a lot of different brands of food and drink that Pepsi has to diversify their portfolio of revenue streams. There are so many different options here, and let me point out a couple that I think are really key. So in a situation like now, when people are spending time at home, they aren't going out to nice fancy restaurants. They're not going out to spend money on new vehicles and very high dollar things like flat screen TVs and stuff like that. One thing that is a very need-based product that you don't really have much of a choice for is food and beverage. You need food and water to eat. That is not a choice. That is a necessity. So in a situation like Aquafina water, Life water, that's a perfect example. A lot of people are still going to drink root beer and still going to drink Pepsi and Mountain Dew, myself included, because it does not matter if you have a job or not as to whether or not you can afford a bag of chips. If you lose your job, you might not be able to afford that new flat screen TV. You might not be able to go out and buy a new car, but you will always be able to afford a bottle of water. So if we look here on Yahoo Finance at PepsiCo, they have a market cap of $183 billion. They are a dividend aristocrat. They have been around for a very long time. They paid out dividends for, I believe, 47 years off the top of my head. They have a dividend yield that's about a little over 3%, and they are very stable. They are very safe. They have a pretty good pile of cash on hand getting ready for this recession. Not that I think it'll matter too much because, like I said, I don't think demand will really soften with the recession going on. They have about $5.7 billion in cash on hand, just ready to go, ready to deploy at any moment. And PepsiCo is all one that you all know of, and I would recommend investing in it as one of my largest investments, and it's not going to be going away anytime soon. So invest in PepsiCo now while it's at a decent valuation and take advantage of it while you can. The next stock is the only stock that I'm going to recommend here that does not pay a dividend, and I do not own this stock. This is Facebook stock. Now, typically, Facebook is not a stock that I would normally recommend as far as recommending one of the high dollar tech companies, one of the big market cap, the $1 trillion club, anything like that. Facebook, Apple, Amazon, Google, stocks like that are typically not stocks that I really pay attention to, not only because they most of the time do not pay dividends, they're usually really overvalued, so I usually don't like that. If you look here, we're going to the forward PE on Facebook. So right now, the forward PE on Facebook is a little over a 19. So that means people are willing to pay 19 times the forward price to earnings ratio for Facebook. So if we were to compare that to a company like, say, Amazon. Amazon is a very popular, it's almost exactly $1 trillion as of right now. Their PE trades at 87. 87 price to earnings ratio. So if you compare that to a company like Facebook, the valuation is extremely better price compared to an Amazon. I love Amazon. I could see myself investing in them one day, but just they don't pay dividends and they're extremely overvalued. But when you look at Facebook, there's a couple reasons why I like it. The first one is people are staying home. We are in lockdown. People do not have a choice as to whether or not they want to leave their homes. So when you're home, what you're going to do, especially if you're not doing any kind of work, you're going to spend time on Netflix, you're going to spend time on your cell phone, you're going to be scrolling through social media, looking at memes, commenting on people's posts, making posts, whatever. Facebook, with all of the different platforms that it owns, Facebook, Instagram, WhatsApp, all that different stuff, they're going to be benefiting from that. Because Facebook is not something that you go and physically purchase. You don't go to the store and buy a Facebook. You log on your cell phone and they send you targeted ads and then they get to get revenue from that. So one of the things I really like about Facebook is that they have $55 billion in cash just ready to go. Facebook, in my opinion, has one of the best balance sheets in the entire world. $55 billion in cash ready to go at any moment. Now, usually, with any public company, especially one of this size, usually carries a pretty substantial or at least a reasonable sized debt. They're usually highly leveraged, and usually that's really dangerous in a time like now when a recession takes place, and that's usually what takes great companies down to just average companies. When you look at Facebook, they have no long-term debt. You're looking here, it's not even on here. They have zero long-term debt. Zero. Your credit card bill is higher than Facebook's long-term debt. They have one of the best balance sheets in the world. They can use that $55 billion to either buy back their own stock down low. They can invest in other companies at significantly cheaper prices. They can pay for research and development. They can give aid to employees, which I know that they have been doing already. There's so many different things that they could do. Potentially what they could even look at doing is buying either other small tech companies at 20, 30, 40% lower than they could have just 3 months ago. So that's something I really like about Facebook, and it's something that I don't see demand really shifting from anytime soon. And Facebook is a very stable long-term company. So the next company that we're going to be talking about is one that I do own in my portfolio, and let me find it, Waste Management. I'm up 1.91%. It's about 3% in my portfolio. I'm up about $1 on it. So if we go to Waste Management, if you've ever seen those green, think clean trucks, those trash trucks that you always see in your neighborhood and in the city, those are Waste Management trucks. What they do is they provide trash services to the public. So one thing that's really cool about Waste Management is that they have very, very, very sticky customers. You might change your cell phone provider. You might switch from Verizon to AT&T. Maybe they're promoting a deal. Maybe they have better service, whatever. You might stop eating Mexican food and go to Italian food. Maybe it's not treating you very healthy. You're not very likely to change what dumpster you have very often. If you have a dumpster or a trash can, you probably keep that the entire time you live at that residence or own that restaurant, whatever. If you have a trash can, it's going to stay there probably for decades. So this $39 billion company, which has a dividend yield of 2.39%, is a very long-term, stable, safe business model. It's one of the largest investments by Bill Gates. I think, actually, off the top of my head, I believe other than Berkshire Hathaway, it is his largest investment. I could be wrong, but looking at the balance sheet, it has $3.5 billion in cash, just ready to go at any moment. $3.5 billion, and you can see that it's grown a lot in this past year. That's something that I really like to see, especially in a time of a recession. So that's awesome. Their debt is not anything that's uncontrollable, not something that's so large. $13 billion for a company this size, that's not that bad. And if they ever did need any kind of financing, and the same thing with a company like Facebook. So what I mentioned earlier was no debt for Facebook. If Facebook did, for some crazy reason, need to go into some kind of debt during this recession, they would have absolutely no issues whatsoever financing any debt that they needed. They are such a stable company with so much cash, and they have no debt hanging over their head, that they could get it in a heartbeat. So in a company like this that also doesn't have some kind of huge debt hanging over its head, something that's uncontrollable, it's really easy to finance in a time like this, and then they probably won't need to take on debt in the first place because they have such sticky customers. They are also raising their dividends every year. They are not a dividend aristocrat, but they are a very stable and safe company. And if this stock were to yield something like 4%, it would probably be one of the biggest stocks in my portfolio. So the next stock is another stock in my portfolio, which is Visa. Visa, I'm up 10.1% on, or about $9. It has 6% in my portfolio. Visa is in a time right now where I think is if you're a growth investor, if you're strictly focusing on share price gains, this is the stock to buy now, today. There's a couple of reasons why. The first one is this is a $377 billion company. It has came down significantly. It was well over $200 just a couple months ago. Let's see here, about 210 or so. When people are staying home, they might be spending more money on like Netflix, or just staying at home playing board games, or buying stuff off of Amazon to get it shipped directly to their home rather than going out and personally buying it. Visa is going to benefit regardless. So if you go to Walmart and you go and buy groceries, or if you stay at home and you buy groceries off of Amazon, either way, you are probably going to pay with a credit card or a debit card. Visa's getting its profit either way. It doesn't matter if you're staying at home when you go and pay your bill with Netflix at home, Visa gets a cut of that. If you go out to the grocery store and you buy sandwich meat, Visa gets a cut of that. Whatever the case, Visa gets a cut every single time you make a transaction. So Visa, looking at their financials here, they have a very considerable cash position. I think the only thing that will slow down is people lose their jobs and they are making less money and they're staying home. The volume will go down some, but they have such incredibly high margins off of their transaction fees that it doesn't really matter. You could probably cut the volume in half and they would still be okay. This is not a company that is anywhere near bankruptcy. They have $12 billion in cash just sitting around. Their long-term debt is $16 billion, so almost the same as their cash position. So they could pay off nearly that entire long-term debt tomorrow and just be perfectly fine. One thing that I really love about Visa that I mentioned in my previous video, one of the reasons why I'm so bullish on Visa and why it's the lowest yielding stock in my portfolio, but it's also one of my highest investments. 85% of the world's financial transactions are done strictly in cash. 85%. So that means only 50% of the world's financial transactions are done through credit and debit cards. As we get further along in the international markets, the lower developing poor countries that are all dealing in cash, as they start to get debit and credit cards and do online transactions. By the way, Visa just bought out a company called Plaid, and as we get further along, people are going to use debit and credit cards more and more. The baby boomer generation writes checks and they use cash. They do not pull out the cell phone and send money through Cash App, and they don't use credit cards to swipe at Walmart. That is something that the newer generations like mine, the millennials and the Gen Zers do. The boomers do not do that. So as we get further along, the millennials and the Gen Zers will begin to graduate high school, they'll begin to graduate college, they'll be getting out of school and they'll be getting on jobs and getting salaries, and they'll begin spending that money as fast as they can using credit and debit cards and replacing those older generations that didn't. So that's why I'm so bullish on Visa, and I think this is a very safe and steady company that is not going to be affected by the recession a whole lot. And when we recover, they're going to come back brighter than ever. Another thing about Visa, one last thing before I get off it, they're one of the largest companies in the world for share buybacks. So if they did get in a position where they did have a lot of issues financially, they can just cut their share buybacks and just spend it towards the dividend and towards expanding the company. So I'm not very big on share buybacks, but in a time like now, if they did stop their share buybacks, they could just use it for other things. So there's just billions of dollars of cash sitting on hand. There you go. The next stock that I'm going to recommend here is the Southern Company. The Southern Company is one of the largest stocks in my portfolio, tied for the third largest. I'm up 5.13%, or about $4.50. It's about 6% of my portfolio. So when we look at the Southern Company, it's a necessity. People are always going to need to pay their electricity bill, regardless of their economic situation. It's a $58 billion company, 4.48% dividend yield, very stable, very high. Utility companies usually pay pretty good on dividends. The dividends growth is slow, but it's usually very safe and stable because they're government regulated. People are going to choose to pay their electricity before they do hardly anything else other than food and water. Your primary needs are food, water, shelter. Shelter includes electricity. So knowing that your kids are safe, that your family's safe, that you're safe sitting in a home with a roof over your head is a first priority before going out and spend money at the newest restaurant or the newest vehicle that's out. Demand is not going to slow down even the slightest bit for the Southern Company. Basically, there's not really a scenario where I can think of the Southern Company where they don't make steady revenues. It would have to be a huge mistake through management, something horrible to make them fault. So Southern Company is a very safe, stable company. They raise their dividend every single year. They actually are due for another dividend raise coming up this next month or so. And yeah, I'm going to be investing more in Southern Company, and that's why it's one of the largest stocks in my portfolio. The last stock that I'm going to list off here, which is a very funny one given the situation, it's one of the lowest gainers in the portfolio. I'm only up 30 cents, or about 0.67%. It's 3% of my portfolio, and that's Kimberly Clark. So Kimberly Clark is a very interesting company in a situation like this. It hasn't fallen very much in share price since the recession. It stayed pretty stable, and there's a reason why. Have you been seeing all the pictures, or in person, all the pictures of Walmart and Costco and everything, where all the aisles are absolutely cleared out of toilet paper and paper towels? Well, these are the company that makes them. Kimberly Clark is the world's largest producer of paper towels, diapers, toilet paper, things like that. They're a $45 billion company. They have a 3.2% dividend yield. They just raised their dividend this quarter, another 4 cents. They are another dividend aristocrat that has been around a very long time. They're a very old company. They dominate the toiletry market. They have about $400,000 cash on hand. That is a little bit lower than the other ones that I've recommended, but the thing about Kimberly Clark is demand has not stayed the same since the recession. This is one of the very few companies where demand has skyrocketed for this company. It is not going away anytime soon. Kimberly Clark is a very old, stable, safe company, and people are going to always need to wipe. As funny as that is to say, you're always going to need toilet paper. It's not going to change. Whether or not you lose your job is not going to change whether or not you need to use toiletries when you use the restroom. So it's very good that we're having this situation where we're locked down for Kimberly Clark, and I think they'll probably be reporting huge numbers as stocks like Netflix and stuff like that will be too, and Kimberly Clark will probably be reporting record numbers in the coming months. So thank you guys so much for watching. I appreciate it if you watched all the way through. I'll be updating you very soon in my portfolio, and I'll be updating you guys on what stocks I'm buying, showing you how my portfolio performs. If you would like to leave any comments and you would like me to address anything, such as what stocks I would have left out in here, what stocks you would have liked to seen. Of the 8 companies that I recommended, did you like some of them? Did you hate some of them? What do you think I should be doing around with the market? Would you like my opinion? Help with anything? Ask anything that you would like in the comment section. I'd love to add it into a video and we can address it soon. Thank you guys so much for watching. Make sure to smash the like button, hit the subscribe button, smash the notification bell, and I'll see you next time.